Hey, hello investors and future investors. Welcome to the channel. For today's video, I'm going to show you how to trade for cash flow. Meaning, I'm going to show you how to trade in order for you to receive money every single time you do a trade. And I'm going to show you how to do this consistently and grow a small account portfolio. Now, if you're new to options trading or you're trying to use options in order to make some additional income, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to show you how to trade for cash flow. This is exactly how I got started, so I'm going to show you how you could do this as well with your portfolio. Now, before we go ahead and get into this video, I need you guys to do yourself two favors. Favor number one, always make sure to do your own due diligence before investing. What may work for my portfolio, quite frankly, may not work for yours. Favor number two, always make sure to have an exit strategy. So, in case the trade do go against you, then at least you know how to get out of the trade. And for today's video, I'll be giving you exit strategies as well. Now, for today's video, we're going to be using none other than Supermicro Computer, and that ticker is going to be SMCI. Now, before we go ahead and get started, let me give you my sentiments about SMCI. Personally, I think Supermicro is a very good company. However, I think the management is crap, and that's what leads to this stock being super volatile. Now, if you are trading for cash flow, you need volatility. The reason why you need volatility is because volatility increases the option premium of the stocks that you trade. So, volatility is good. Now, before we go ahead and show you how to make consistent income, let me go ahead and jump into the graph. By the end of today's video, you should be able to jump into any brokerage account right now, start trading right now, and able to make your first amount of money by the time this video has ended. So that is my goal for today's video. Now, let's go ahead and get into the charts. Let's go to the advanced feature right here, and that's going to open up the Robinhood charts. Now, depends on the time frame that you want to trade. Feel free to go ahead and choose whichever one here. I'm going to go ahead with the 1Y, which represents 1 year, because most of my options trade expiration is either going to be a year, 45 days, or 30 days. Now, the reason why I have this graph right here is to show you just two indicators that you really need. You don't need to know how to manage the candles. You do not need how to know what kind of time frames you need to use. You don't need any of that. I'm going to show you two simple indicators. If you just start trading options today, that's going to work for you. So indicator number one is going to be this blue line right here, which is the 200-day moving average. What the 200-day moving average does is that it gives you the price the stock is trading at for the last 200 days or 6 months. Now, how do I use this? Of course, you could use the 200 days in different ways, but I'm going to show you how I use it. So, for instance, whenever this graph right here, whenever the price goes below the 200-day moving average, then it moves to the top of my watch list, because then I start thinking of what option strategy or how I could benefit from that particular stock. So as you can see here, all these graphs here is below the 200-day moving average. So that'll be a good time to start watching this stock. Right now, the current share price is above the 200-day moving average. So that's indicator number one. Indicator number two that's going to help you make a decision in order for you to start trading for cash flow is going to be your relative strength index, or your RSI. Your RSI is down here, and this is what's known as a momentum indicator. What the RSI does is that it shows you whether the share price of the stock is overbought or oversold. Now, once you're going up to the RSI, it goes all the way up to 100. But when you're going up from the 50, anything goes all the way up. The closer you get to 70, that tells you that the stock is now being overbought. Now, vice versa, when you go below the 50, so imagine this, the 50 is the medium mark. When the RSI starts going below 50, the closer you get to the 30 mark, that tells you that the stock is now being oversold. So depends on the option strategy you want to use. You could use the RSI, either the top of the 50 or the bottom of the 50. Now, in order for you to trade for cash flow, one of the things you have to do is to sell options. You could do either of two things. You could buy options or you could sell options. What selling option does is that it allows you to get money right away as soon as you do the strategies. So What we're going to do now, SMCI, I'm going to draw a simple line right across here. And as you can see, this line here is going to coincide with around the $40 price range. And this graph touched the line several times if you go all the way to the left. Now, that's one level of what's known as support. Now, if I go to the bottom line here, and I do the same thing, you could see the graph has touched this line a couple times as well. This is another level of support. So what that helps you to decide is that if this share price continues to come down, it might stop around the $40 mark. $40 is going to be a range. If it breaks the $40 mark, which is the first level of support, it can continue to go down all the way up to the next level of support, which is going to be around the 30-ish range. Now you just need these numbers to keep in your head, and just helps you with your strike price. So let me go ahead now and show you how to trade for cash flow. Hopefully you guys understand that. Now, even if you do not understand that, I'm going to show you an option trick that you can use to make this extremely simple. So here goes. Right now, as of making this video, we're in a bullish market. So the sentiment is green. So we're going to be doing a bullish option strategy. So we're going to go down to trade SMCI down here to the bottom in order to first open up the option chain. Now, for those of you that are new to the channel, or for those of you new to option, all this information down here in its entirety is what's known as the option chain. Now, what the option chain does, it gives us enough information in order for us to make a very informed decision before entering any option contract. So here's what we're going to do. We're going to first go to sell. We're going to go to put, and now we're going to be choosing an expiration date. The expiration date we're going to be going with is going to be September 12th, which gives us 29 days to expiration. We're going to be doing monthlies. Now, when it comes time to the expiration date, feel free to choose something that works for you. If you do work a 9 to 5 and you get paid on a weekly basis, then perhaps you should use the bi-weekly options. And if you get paid on a monthly basis, then you should use the monthly expiration. Remember, always choose what works for your portfolio, what's best for you. Now we have sell, now we have put, and we have our monthly expiration. I'm going to go ahead and choose a strike price. Remember, we're trading for cash flow, so there's something that you need to pay very close attention to. The strike price I'm going to go ahead and choose is going to be the $40 strike price. Now, I did just demonstrate that the first level of support for Supermicro is going to be the $40 support, is going to be the $40 strike price, sorry. So I'm going to go ahead and choose that. Now, with the $40 strike price here, you have a chance of profitability. The chance of profitability is going to be 79%. You don't really need the chance of profitability in this case, because what you're going off of, the basis you're using to choose your strike price, is the level of support that I demonstrated in the graph. So $40. We're going to go ahead, we're going to click into this. Now, this option strategy is going to be known as the cash secured put. Whenever you go ahead and do this option strategy, you get paid right away. Hence, you're trading for cash flow. As soon as you get paid, the amount of money you're going to get paid is going to be this $86 here. Now, here's the kicker when you're trading for cash flow. Anytime you do an option strategy, you should get paid. The reason for that is that the money you receive when you get paid, in this case is $86, that is going to be your money to do what you want with. You keep that money no matter what happens to the trade, whether the trade goes in your favor or the trade goes not in your favor. That money is always going to be yours to keep. Hence, you always keep doing this in order to raise cash flow. Now, you can keep doing this option strategy. You just rinse, you repeat, you keep doing it over and over again. In order for you to do it over and over again, this is what has to happen. Come expiration date of September 12th, what you want, ideally, you want this share price here of $45. You want it to stay above the $40 price. If it does stay above the $40 price, then you're going to receive back your collateral. One of the major criteria in order for you to do this option strategy is that you're going to have to leave a collateral. The collateral in this case, or in all cases when you do this option strategy, is always going to be whatever your strike price is, multiply that by 100. The reason why you're going to multiply by 100 is because you're doing an option contract. Every single option contract contains 100 shares. So $40 multiply by 100, which is one contract, and you're going to have to leave $4,000 as collateral. So that $4,000 is going to be released back to you come expiration date whenever this share price stays above the $40 strike price. And then you have your opportunity to go ahead, you rinse, you repeat, and you keep doing this strategy over and over and over in order for you to receive cash flow. If you so happen to do this 12 times out a year for 12 months, you should average around $1,032 for the year. Hopefully, my math is mathing. So that's pretty decent return on a simple option strategy that gives you some extra income. Now, I know some people in the comments are going to be saying, what if the market has a pullback or we're in a bearish market? Then that's fine. When you're trading for cash flow, you don't really care whether you're in a bullish market or whether you're in a bearish market. No one could predict the outcome of the market. There's only one thing we can do, and that is be prepared. So, this is how you get prepared. So the other way this trade could go now is that, remember, if the trade goes in your favor, you get your $4,000 collateral released back to you. You keep your $86 and Bob's your uncle. Now, the other way this could go, if this share price now happens to go below the $40 strike price come expiration date of September 12th, then you have an obligation to buy 100 shares at this price. It doesn't matter if the price is trading like, let's say, $38, you still have to buy 100 shares at a $40 price, strike price, but that is fine because this is what's going to happen. Now you're going to own 100 shares of SMCI in your portfolio. Now, before I continue, here's another good thing you must do. Whenever you're doing this option strategy, always try to do it on a stock you don't mind owning in your portfolio. Because sometimes whenever you do get assigned, you may have to keep that stock in your portfolio for a couple of months, a couple of weeks, etc. So always make sure you use a stock that you want to own in your portfolio. So back to it. So what's going to happen is now you're going to own 100 shares of a stock you already wanted in your portfolio, but now you're going to own it at a lower price than what it was currently trading at whenever you got into the option contract. So you actually buying the stock that you like at a discount. Now that you have 100 shares of the stock in your portfolio and you got it at a discount, but now we're in a bearish market. So you still want to make cash flow. This is what you do. It's a simple flipping of the switch. So we're just going to change up the strategies. So the basis for this strategy, this new strategy, is going to be that you now own 100 shares of the stock at the $40 mark. So now we're going to go ahead to sell once again. We're going to go ahead to call. And let's just use monthly expiration date again. So now what we're going to do, we're going to go ahead and sell more in order to get more cash flow. Now, what we're going to be selling, we're going to be selling at any price above the $40 price. The $40 price is the price that we will force to buy 100 shares. So, in order for you to keep generating cash flow, you're going to sell any price above this. So, in this case, let's go with the I'm going to go with the $45 price right now, and that's going to pay me $3.15 or $315. Now, remember, what I want you guys to focus on is the actual strategies, because obviously this is not the price it's going to be paying, because it's going to be 30 days from today, from the day of making this video. So this is just an example. So you're going to be receiving $3.15 in your portfolio. Once again, that $3.15 is going to equate to $315. That $315 is going to be cash flow. That money comes to your portfolio, and then you're allowed to use that money for whatever you want. You never have to give that money back to the market. Now, this new option strategy for increased cash flow is what's going to be known as the covered call option strategy. The covered call option strategy can be used on any stock. It's all going to depend on the size of your portfolio. Now, if you're doing only one option contract and you are going to make around $315, imagine how much more money you would make the bigger your portfolio is. So always try your best to grow your portfolio and do not take a lot of money out of your portfolio. So now that you're getting $315 cash flow, every single month you're going to rinse, repeat once again. Now, if it's a stock you happen to buy and you don't want to keep the stock in your portfolio anymore, you could make a slight little adjustment. Here's what you're going to do. Instead of selling at the $45 strike price, which is way higher than the $40 strike price, all you can do, you're simply going to go down and you're going to reduce your strike price. So let me just show you right here. So instead of going for the 45, we could always go to the 43 strike price. Now, whenever you decide to go ahead and reduce your strike price, you're going to increase the chance of you being assigned. And I'm going to explain assignment to you in just a second. But for now, let me show you. Whenever you reduce your strike price, you're going to increase your cash flow. Your cash flow in this case is now going to be $405, as opposed to when you had the $45 strike, your amount of cash flow you receive was 315. So whenever you reduce the strike price, your cash flow increases. Now, how does this trade work out? We're going to stick with the $45 strike price for now in order for me to explain how this trade could work out. So come expiration date of September 12th, you now sell in the covered call. So you ideally want the share price. You want the share price to remain below the strike price you chose. In this case, it's going to be $45. Whenever the share price stays below that, then you keep your $315. Remember, that's cash flow. That's never going to be taken away from you. Then you're going to get your 100 shares that you use as collateral released back to you. The important criteria for you to do the covered call is that you must own 100 shares. Remember, the first option strategy I showed you, in order for you to create cash flow, you must have the cash and leave the cash as collateral. For the covered call, you must own the stocks and then use the stocks for collateral. So that 100 shares of stock going to release back to you, and then you rinse, you repeat, you keep making cash flow, you grow your accounts portfolio. Now, the other way this trade could go, come expiration date once again, if this share price goes above your $45 price, remember we bought it at $40. We sold at $45. So if the share price happens to go past $45, then you're going to keep your $315. That cash flow is always going to be yours. So that's how you trade for cash flow. Now, you're going to keep your cash flow of $315, but you're going to lose your 100 shares of stock. Now, losing your 100 shares of stock is not going to be such a bad thing, and here's why. When you got assigned on the stock at a $40 price, so you actually paid $40 multiplied by 100 shares, you paid $4,000 for the stock. Now you're going to be assigned, meaning you're going to lose your 100 shares that you bought at $40, but now you're going to be assigned, you're going to be losing it at $45 per share. So now you're going to have to sell it, and you're going to receive in your portfolio $4,500. So now you're going to make some additional money. So in addition to the cash flow you're going to be making here, you're going to get what's going to be known as capital appreciation or share price appreciation, or how I like to call in this channel, investment gains. So now that's going to be your difference between your $45 that you forced to sell it at. Remember, that's your assignment price. You're going to subtract your $40 price you paid for it. It's going to give you a $5 difference. That $5 you're going to multiply by 100 shares. Remember, we initially started off by saying each option contract does contain 100 shares. So you multiply your $5 by 100 shares, that's going to give you $500. So in addition to your cash flow of $315, you also going to get some investment gains of $500. So investors and future investors, that's how you trade for cash flow. Whenever you're trading for cash flow, do not concern yourself in whether the market is going to go up, the market is going to go down. No one can predict that. All you could do is go ahead and do income generating option strategies in order for it to get consistent income. Sooner or later, the market is going to turn against you and you're going to have to change your strategies. Once you change your strategies, all you're going to do is to continue making cash flow. The constant cash flow you keep making, that's what allows you to keep growing your option portfolio. And that's how I got started with options trading. Now, if you guys have any questions about how to trade options in order to get consistent income, or how to trade options for cash flow, then let me know in the comments below. Now, if you also have any questions about the strategies I showed you in today's video, which is going to be the cash secured put, the covered call option strategy, then let me know in the comments below. Now, for those of you who have made it to the end of the video, you guys are the real investors and future investors, and you guys have shown that you're committed to growing a small account portfolio and generate cash flow in addition to your 9 to 5. So if you haven't already, now would be a perfect opportunity for you to go ahead and like the video, subscribe to the channel. Make sure to hit the notification bell to get an alert when I post a video. But most importantly, if there's someone out there you know struggling to grow a small account portfolio, then the best thing to do is to go ahead and share this video with them. Let's try to help as many people as we can start making income from options trading. And eventually, if all goes well, then they could probably be able to leave their 9 to 5 and become a full-time options trader for cash flow. Now, until the next video, keep pushing your investments.